people have kind of forgotten about that, and they instead go to ETFs or index funds. And that's not saving, that's investing. It's a very, very different thing. So when people think they're saving, they're actually investing. They're taking on more risk than they think they are. But in my view, having the Chinese government intervene and buy ETFs or buy securities, this doesn't stabilize anything. This is the cause of the problem. This is the pumping more distortions into the market.
Now, we always say to our clients, the best returns from precious metal investments over the long term. It's not about timing the market, it's about time in the market. You've said it many, many times on the show, but still people want good information. So I wanted to share basically my short list of where do I look for information? What are some of the KPIs or the indicators that I'm looking at? So
welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Are regional banks at risk? What is happening in China? And what if the US debt bubble bursts? We will discuss this and more with our guest, Nick Giambruno of the Financial Underground. Hello, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals with the brightest minds in the space. If you are new to the show, you can find our previous episodes on the Strategic Wealth Preservation YouTube channel. While you're there, please be sure to like and subscribe. Leave a comment with any questions you might have, and we'll touch on them in upcoming episodes. My name is Jeremy Varlow. I'm excited to be with you again today. As I mentioned, I will be joined today by Nick Giambruno from the Financial Underground shortly. But to kick things off, let's get our weekly market update with CEO of SWP, Mark Yaxley. Mark, what's going on out there?
Hey, Jeremy, good to see you. And really looking forward to having Nick back on the show. Always interesting to hear what he has to say. For this week's market update, let's begin with China. I think that's the headline news right now. The takeaway for me was that this morning, the CSI 300, which is an index that replicates the performance of the top 300 stocks traded on the Shanghai Stock Exchange, is down 20% year over year. And to give you some perspective, the Indian exchange is up about 20 or 25% year over year. So really a contrast there between two very large economies in Asia. Its performance is of great concern to both Chinese and international investors. And aside from having wiped out about $2 trillion worth of value for investors thus far, it's also putting a lot of macro pressures on industrial precious metals, being silver, platinum, and palladium. So if you are investing in silver, platinum, and palladium, kind of wondering why is it, why aren't those metals performing? One of the reasons is the world's second largest economy is struggling right now. On the flip side of that, a risky Chinese economy is actually really good for gold. The stock market volatility, capital controls that they have in place, and concerns about the real estate market there have actually led to record demand for gold bullion amongst Chinese investors. Gold bullion sales rose over 30% year over year in 2023. And that's one of the reasons that gold is still above $2,000 an ounce, globally speaking. Then you've got the tensions in the Middle East. You've probably already heard the news that there have been a number of air raids conducted by the US and UK military on targets in Syria and in Iraq as retaliation to the 3 servicemen and 25 others that were injured last week. There was another attack on a US military base in Syria that killed 6 allied fighters over the weekend. So there's ongoing escalation, not only in the war in Gaza itself, but in the region, which is supportive of a higher gold price. The US dollar continues to strengthen. We talked about this last week. The Dixie reached 104.5 as of this morning, which is the highest level that it's had since December. A strong US dollar, of course, has a negative effect, a direct one-to-one correlation on the price of gold because it is priced in US dollars globally. Following Fed Chairman Powell's latest comments, only 20% of the market now believes that the first interest rate cut is going to be happening in March. And the majority of the market now believes that that first rate cut will happen in May. And that higher for longer interest rate strategy is going to put some downward pressure on the price of gold and silver and historical trends. Historically, the 30 days after the Chinese New Year, the price of gold goes up about 3.1%, and that's been measured since 2007. So maybe there is a little bit of upside in our near future for the price of gold based on the festivities in China. Back to you, Jeremy.
Let's certainly hope so. Thank you for that, Mark. Lots going on there, both in the geopolitical and macroeconomic arenas, respectively. And I can't think of many people we'd rather have this conversation with than our guest today. As I mentioned, Nick Giambruno is back in the hot seat after joining us a couple of months back on one of our earlier episodes. Nick, of course, is a seasoned financial analyst, having written for a number of publications, and is the founder of the Financial Underground, offering insights into global finance, investment, and geopolitics. Nick, welcome back to the show.
Hey, Jeremy. Hey, Mark. Great to be with you guys.
Great to have you. Let's jump right into things here. And I want to start by setting a little bit of context based on your writings for the Financial Underground and your background. Your work and writing offers readers actionable approaches to weathering economic storms and thriving amidst market disruptions, really by understanding the relationships between geopolitics, economics, and finance. And there's a lot to unpack there. The average investor might not have, time or full understanding of all these relationships. How do you make it digestible and understandable for the people to comprehend and act upon?
Yeah, well, I think it is complicated. There's a lot of moving pieces. Looking at taking somebody's geopolitical view of the world, how that integrates with markets and finance and portfolio strategy and all this stuff. So I just try to break it down into smaller pieces and then put it all together at the end. And that's really what you've got to do, because you don't want to get too bogged down in the details that you miss the big picture. That's the whole point. You want to get the big picture right. And if you get bogged down in the details and get the big picture wrong, you kind of didn't get it right. So no, I really focus on getting the big picture geopolitically, financially, economically, and so forth, right? Because I think that's the foundation for everything else.
Yeah, it's the old adage of separating the signal from the noise, so to speak. And there's lots to be learned from your writing, and we'll definitely plug that at the end of the show. Definitely recommend everyone go check out the Financial Underground. Let's dig into Mark's market update. Obviously, lots to talk about there. We'll start first with China very briefly. Is this kind of the elephant in the room? As Mark mentioned, some of their stock indexes are down. I was reading earlier that the government has started purchasing ETFs to help support the market, and authorities are really scrambling for answers on what's going on over there. Like I asked, is China this kind of elephant in the room that we should be worried about, possibly leading to more kind of market turbulence more globally?
Certainly, because of China's size. If there's turmoil in China, it's going to go throughout the world just because of how connected it is, just how big it is. But in my view, having the Chinese government intervene and buy ETFs or buy securities, this doesn't stabilize anything. This is the cause of the problem. This is the pumping more distortions into the market. So no, it might kick the can down the road, but you're trading for an even bigger crisis down the road. So I think that's point number one. Point number two is, I think, and this is not unique to the Chinese, most people around the world don't understand the difference between savings and investing. And because fiat currencies, whether it's the US dollar, the Chinese renminbi, the euro, any fiat currency, people kind of intuitively understand it's not optimal to save in these things, because over the long term, their value just melts away. So where do they park their savings? Previously they could park their savings in dollars and other currencies because they were just derivatives of gold. They were a representation of gold or gold. But now that people have kind of forgotten about that, and they instead go to ETFs or index funds. And that's not saving, that's investing. It's a very, very different thing. So when people think they're saving, they're actually investing. They're taking on more risk than they think they are. And when things like this happen, it's much more painful, because this is something that people are allocating money that they want to be in a safe place into riskier assets. And that's a consequence of this whole fiat currency system. You see it everywhere, and this is an example of that. And then the Chinese are culturally more attuned to gold than Westerners. They're way more familiar with it. So I think they're going to be rediscovering. They'll be much quicker learners than Westerners when this kind of stuff happens, that they'll go back to a superior savings vehicle, which is gold.
That's a great soundbite. Thank you for that. And I love the what is savings versus what is investing. I also want to ask you the what is money question, because you have a great answer to that as well. But we'll come to that in just a moment. I want to pivot now to US debt, which is something you also write about a lot. You wrote an article about the 2024 debt spiral and what higher interest rates mean for that debt. And you argue that higher rates mean higher inflation. Could you walk our viewers through that a little bit?
Yeah, that's contrary to conventional wisdom, but it's absolutely true. And it's not very hard to understand why, because higher interest, because of the debt is so enormous. It's over $34 trillion. And I always you could put these numbers into perspective. $1 trillion, if you earned $1 a second, 24/7, 365, it would take you about 11 days to earn $1 million. It would take you about 31 years to earn $1 billion. But to earn $1 trillion, if you earned $1 a second, 24/7, 365, it would take you 32,000 years. 32,000 years. It's nuts. So when they're talking about trillions, you got to wrap your minds around. You got to wrap your mind around what they're talking about. They might as well be talking about a gazillion. Some kind of people just don't put this into context. So a trillion, 34 trillion is an astronomical amount of money. It's incomprehensible. And interest on that. Interest on 34 trillion. Okay, so this is why it's going to cause inflation, because they have to pay interest on this debt. And as the interest rates go up, the interest expense goes up. Well, the interest expense is projected to go over $1 trillion for the first time ever for the U.S. Well, they print money. So that's the thing, is that's how higher interest rates cause a higher interest expense, cause a higher budget deficit, which causes more money printing, which is inflation. So that's what it is. Aside from these Keynesians and these people with these sophistry arguments talking about, this is going to tame inflation. I mean, so no, this is inflation. Money, the increase in the money supply is inflation. So the higher interest rates are going to cause higher inflation because of the debt, and it's only going to get worse.
So then just a quick follow-up question to that, and I appreciate that answer. What is the way out? Is there at this point a way out, or is it a fool's game?
I don't think there's a way out, because the only way out is to, okay, so you look at the budget. The biggest items in the budget are Social Security, welfare of all kinds, and the military. Right? If you are not going to cut welfare, Social Security, or the military, it's not going to make a difference. You can, cut around the edges, but it's really not going to move the needle unless you cut those three things. And there's zero political will to cut any of those things. In fact, they're going to go up. Social Security is going to go up because boomers are retiring now more and more. And it's kind of like an inverted pyramid. It's a Ponzi scheme. Social Security is a Ponzi scheme. It's socialist. I call it, it's a better word for it is socialist insecurity. So that is not going to go down, and no politician is going to cut Social Security. It's ridiculous. Welfare? Do you think they're going to cut? You think they're going to cut welfare? I don't think so. That people have become addicted to this stuff. I think welfare is going to go up. There's going to be universal basic income. There's going to be more welfare. So not only is this stuff not going to go down, it's going to go up. And then military spending. You think they're going to cut the military spending in the most geopolitically precarious time since World War II? Yeah, right. The military spending has nowhere to go but up. So the budget deficit they're screwed. I mean, yes, theoretically you could cut it, but practically it's not going to happen. And on the income side, even if tax rates went to 100%, the deficits would still grow. So the deficits are not going to stop, is the point. And what does that mean? It means the money printing is not going to stop. The currency debasement is not going to stop. So I think that's the bottom line, is that currency debasement is inevitable, and all the rest is noise.
Yeah, I'd agree with that. Let's now pivot into the banks then, because obviously the big news over the last week was with U.S. regional bank stocks selling off amid concerns around poor earnings. The Fed's continued insistence that rates may stay higher for longer, as Mark mentioned. There are further fears about commercial real estate loans, the effect of these persistently high interest rates. Are we kind of staring down the barrel of the same bank issues that we had about this time last year?
Oh, I think there's absolutely going to be trouble in the banking system. The banking system is basically a legalized fraud, frankly, because I always tell people three very simple facts about the banking system. Number one, the money isn't yours. People conflate this. They think when they deposit money in the bank that it's like the same as having a $100 bill in their hand. It's absolutely not the case. When you give money to the bank, you have an IOU from the bank. You don't have $100 in your hand. You have an IOU $100 from the bank. Very different thing, technically and legally. You are an unsecured, you're basically making an unsecured loan to the bank with no interest to compensate you for taking such a risk. It's a really crappy deal for you and a really good deal for the bank. So that's number one. The money's not yours. Number two, the money isn't even there. Like, even if the money was yours, the money isn't even there. If say 5%, 10%, a handful of depositors went to the bank and said, I'd like my money, please. It's not there. They've lent it out. Fractional reserve should not be allowed in a free society. It's basically a fraudulent activity. Imagine fractional reserve applied to any other business, like say a fractional reserve car dealership or a fractional reserve jewelry store where they're selling 10x the claims to the cars or 10x the claims to the jewelry than exist, or like somebody who owns a stadium. Say they're selling 10x more tickets to the stadium than there are seats in the stadium. This is a fraud. This is clearly a fraud. So number one, money's not yours. Number two, the money's not there. And number three, the money is not even money. The money is fake money. This is confetti money. This is money that the politicians create out of thin air. And, let's talk, this is a good part to talk about the definition of money. Money does not need to come from the government. This is ridiculous. This is kind of like a slave mentality that I need the government to give me money. This is ridiculous. Money is a very simple thing. It's a tool for sending value through time and space. That's it. That's all it is. It's something that's useful for storing and exchanging value. That's all it is. You don't need the government for that. In fact, money has existed long before governments existed. So people are very misled into thinking that the money they have in the bank is actually money. It's a very inferior money. It's a money that some people can make without effort, and you have to work 40, 50, 60 hours a week running on a hamster wheel chasing this confetti. For those three reasons, money's not yours, money's not there, and the money's not money. I think the banking system, it's guaranteed to have more problems. We're just seeing the tip of the iceberg. So yes, it's all backstopped, of course, by the Federal Reserve, which is to say a legalized counterfeiting operation. So you have this legal Ponzi scheme backstopped by a legal counterfeiting operation. It can go on as long as the currency holds value. So and it's rapidly losing value. So yes, I think problems in the banking system are guaranteed. That's going to translate into even more currency debasement. Like I was saying before, if you're going to take one takeaway from this, it's that currency debasement is inevitable and everything else is noise. And this just compounds the currency debasement situation problems in the banking system.
Yeah, and Fed Chair Powell actually gave an interview for 60 Minutes, which Mark mentioned at the top of the show. And he actually went so far as to say that these smaller banks may have to be closed or merged out of existence due to these losses, which seems a little bit counterintuitive. You're going to have, all these large banks start acquiring the smaller banks. And I mean, I saw another piece of commentary earlier this week about the derivatives exposure in these large banks, which is just ginormous, like figures I can't even comprehend. So it just kind of feels like you're trading in one bad issue for another. But yeah, thank you again very much for that commentary. I want to move on to CBDCs, or central bank digital currencies, which you speak about a lot as well, which kind of seems to be touted as the solution to these problems. I know you're a big proponent of Bitcoin, which, is something we're going to talk about in just a moment. But CBDCs, as I mentioned, they've been, touted as the solution. They're those that are native to kind of the cryptocurrency or Bitcoin landscape know that this is completely counter to that whole ethos, as it, has a certain element of government control to it. What is your take on CBDCs, and how close are we to seeing them instituted?
Yes, well, CBDCs are a quantum leap backwards in human freedom and economic freedom. They're terrible. They're an instrument, frankly, of enslavement. They're designed to control you and designed to harvest your economic activity for the people who issue the CBDCs. So no, I hope they fail. And the good news is they will fail. They're destined to fail. They're nothing but the same fiat currency scam with a shiny new label on it. It's not going to fundamentally change anything. In fact, the first CBDC was the Venezuelan Petro. Did it save the Venezuelan Bolivar? No. Would a CBDC save the Argentine peso? No. Would a CBDC save the Lebanese lira? No. So if these fiat currencies, which are fundamentally unsound, which I believe all of them are, having the ability for the government to exercise more control, more in manipulation, more debasement, is that going to make these things better? Of course not. It's just going to make them destroy their currencies faster. So they're horrible things. You can see what they want to do with them, but the practical reality is that they are terrible forms of money. They enable even more currency debasement, and they're destined to fail. So I'm not too worried about them. They do seem dystopian and scary, but the good news is they're destined to self-destruct.
That is a very succinct answer, and I love that. And I think it pivots us nicely into our next topic. So, everything that we have discussed from the top of the show today to now really makes the case for precious metals as an investment, as a way to protect against inflation and protect wealth. You argue that there is a third hedge, a third asset that people should be looking at as a wealth preservation asset, and that is Bitcoin. And, obviously, historically, it's been a very volatile asset, which in recent years, I think that the Bitcoin market has matured to the point where it's much less volatile than it was, 8 years ago. And it's more readily understood. There's tons of great content out there to educate yourself. But maybe you can kind of give us the layman's terms on why you think Bitcoin is that third hedge.
Oh, certainly. Just to briefly touch on your point, yeah, I think precious metals are a superior savings vehicle. We're talking about savings vehicles. People are saving in the stock market. People are saving in the banking system. These are terrible ways to save your value for the future. Precious metals, where you have an unallocated full interest in the metal, no other competing claims, no other unnecessary counterparty risk. That's a superior savings vehicle. And in the same vein, Bitcoin is I would call it an emerging savings vehicle. It's not established. Gold is clearly established. It's been around for thousands of years, over 5,000 years. Bitcoin has been around since 2009, so it's very, very new. But it has the same attributes that make it a desirable savings vehicle for the long term. And with Bitcoin, if you're looking, I always say, if anybody's looking to put any money into Bitcoin, at least have a 4-year time horizon. That might sound long, but this is a new asset, and that at least gets you through one halving cycle, which is, the Bitcoin supply growth gets cut in half every 4 years. Kind of creates a predictable cycle. And if you look at, there's barely, maybe a couple times, very, very rarely, has there ever been an instance where the Bitcoin price has been lower than it was 4 years ago. So I always tell people, have a 4-year time horizon. This is a new, novel asset. It contains many of the same properties that make it highly desirable as a savings vehicle, but it's a new thing. So it is very volatile. And in that sense, usually a smaller position, a smaller allocation makes sense. And because it's volatile means to the upside too. So a smaller position can have an outsized effect on people as well. So yes, it shares many of the same qualities as gold. It's, why it's popularly referred to as digital gold. Most importantly is that it's resistant to debasement. Debasement is the key theme here, because that's the key threat. The key threat to you as a saver is debasement. Somebody else diluting your ownership over the supply. Now, gold is the most, out of all the physical commodities, it is the most resistant to debasement of any physical commodity, which is why it's been money for thousands of years, in my opinion. That's the one. If you had to distill gold down to one factor, that's it. It's nobody can debase it. It's very, very hard to debase. And in the same way, Bitcoin has that feature too. So yeah, I think these are free market savings vehicles. You don't want to use government savings vehicles. I mean, fiat currency is a government savings vehicle. The banking system is de facto owned by the government. I mean, it's a de facto state entity. I know they're nominally private institutions, But, the banking system wouldn't exist without the government. It's certainly not in a free market the way it exists right now. No way it would be, it would fail without the kind of backstops that they get from the central bank. So I consider the banking system, even though it's nominally part of the free market, it's not really a private entity because it depends on the government, and it wouldn't exist in its current form in a totally free market. So yes, I like gold and Bitcoin as free market savings vehicles.
That is the perfect answer. Really appreciate that, Nick. We're going to wrap things there. We really appreciate your time as always. Last thing before we let you go, where can our viewers go to learn more about you, your writings, and your investment strategies?
Sure. The easiest way is to just go to financialunderground.com. I have a really helpful special report that people can download there. Contains some of my top tips on investing in gold, Bitcoin, how I see the geopolitical picture. So I think people will find that special report interesting. That's available on financialunderground.com.
All right. Thank you, Nick Giambruno from the Financial Underground. Once again, Nick, looking forward to having you back again soon.
Thanks, Jeremy, and thank you, Mark. Hope you guys have a good one.
Cheers. All right, we're going to finish off as we always do with our weekly Bullion Basics segment with Mark. Let's bring him back in, see what he's got for us.
Hey, Jeremy, and great having Nick on. Like, really interesting stuff today. I thought Nick did a great job kind of unraveling some seemingly complicated topics, made everything seem pretty straightforward. So a really good interview, Nick. Thanks for coming out. I think today's Bullion Basics kind of ties into some of the things that Nick writes about, that he talks about. And what I wanted to speak about today, Jeremy, is, we kind of get this question from our clients a lot, as you would know, they're always looking for good information. And I think, let's just start this off by saying, follow guys like Nick, the Financial Underground, follow guys like Doug Casey, and the research that they put out. But if you're looking for indicators of where the precious metals market is going, I put together a short list of places or information that you can pay attention to. Now, we always say to our clients, the best returns from precious metal investments over the long term, it's not about time in the market, it's about time in the market. You've said it many, many times on the show, but still people want good information. So I wanted to share basically my short list of where do I look for information? What are some of the KPIs or the indicators that I'm looking at? So the first thing I'm going to say is the one thing you don't have to worry about when it comes to precious metals is on the supply side. Annual mining supply of precious metals is extremely steady. It varies like 1 or 2% year over year. And anytime there's a shortage in mining output, there's more than enough secondary market, aka scrap metal, recycled metal, to make up for that shortfall. So in short, there's never really a true shortage of precious metals. You don't have to focus too much of your energy thinking about the supply side. Where you need to spend more of your time doing research or taking a look at things is on the demand side. That's much more volatile. The demand for gold is made up of 4 particular components. You've got the industrial demand, you've got central bank demand, you've got ETF demand, and then you have retail investors who are buying physical bullion. If you want straightforward, good data about the demand side of the equation, I recommend that you go to the World Gold Council's website. It's gold.org. They have a free newsletter that monitors trends in jewelry demand, central bank, ETF, and retail investors. So you're going to get all of that data fed to you. And like I said, it's free. So it's a great starting point if you're going to start paying attention to the demand and the impact that that has on the precious metals price. You're also going to want to pay attention, obviously, to the US dollar. It's something that we monitor closely at SWP. Gold is priced in USD on the international market. So the strength of the US dollar has a 1-to-1 correlation with the gold price. When the dollar is up, gold is down. And when the dollar is down, the gold price is going to be up. Pay particular attention if you're looking for a good indicator to the Dixie, the DXY. It's an index that measures the strength of the US dollar, and that's available on any financial website, or you can just Google it for a snapshot. Then shifting gears a little bit, the other things you're going to want to pay attention to, and this is where guys like Nick and Doug Casey, just like they're the experts in the field, is geopolitical risk. So generally available in any newspaper publication or any credible publication, you're going to be wanting to look for not only things like war and conflict that you see in the Ukraine or you're seeing in Gaza right now, but one level below that is you're going to want to look at developing tensions in other countries. For example, Taiwan and China, the tension that they have right now, North Korea and South Korea. the US and, you know, their allies and the tensions that are developing between them and the BRIC countries. So those developing tensions are also important to monitor because they can become the next conflicts. And that's really where you can maybe place an early bet on precious metals and hope that it pays off as things develop over the years. And lastly, obviously, you want to familiarize yourself with macroeconomic trends. You know, you want to monitor the US economic data. You want to monitor Chinese data. Right now, for example, you have strong data coming out of the US, and you have really poor data coming out of China with their struggles in the real estate market, with their struggles that we talked about in the stock market. So monitor those major economies. Obviously, the EU, the BRIC countries, again, are important ones to keep an eye on. And like I said, if you want to go next level, sign up for Financial Underground, sign up for Doug Casey's International Man, and follow guys like Nick and Doug to go one step further.
Awesome. Appreciate that, Mark. Thank you very much. That is all for us today. Thank you so much once again for watching, and to Nick Giambruno for joining us. Make sure to check out his site, the Financial Underground, for more information. And lastly, head on over to the Strategic Wealth Preservation YouTube channel for our past episodes and lots of other educational content pertaining to precious metals. And leave a like, subscribe while you're there, and comment. And until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.